Working with Encore provides you access to unlimited capital. You found yourself in some sort of trouble. We want to figure out a way to get you out of that.
Meet Craig Cohen, VP of Business Development at Encore Funding.
Encore Funding is a leader in specialized financing for government contractors.
Banks and financial institutions take advantage of people.
Their main objective is to really minimize their own risk. To minimize their risk, they often quickly disqualify. Money has become such a commodity. There's always some place to get it cheaper.
You know, I've never heard that before where you said that they don't allow you to leave.
Even if you don't borrow 1 penny from them, they're still going to charge you a percentage of the amount that you're not borrowing. We believe fully in transparency.
What are some of the red flags?
So oftentimes the bank will say, we will make available up to. Here at Encore, there is no up to.
Do you have any real world examples? One of the things that we talked about in our last interview were different ways that banks and financial institutions take advantage of people. Can we talk about that today? And before you get started, make sure to introduce yourself and where we're at.
Hi, everybody. My name is Craig Cohen. I'm the VP of Business Development here at Encore Funding. We focus on specialized and alternative lending for GovCon, and we're going to talk about a variety of alternative financing today.
First of all, can you walk us through some of the common tactics that banks and financial institutions use when working with small businesses?
You know, Eric, so banks are really, their main objective, you know, I hate to say that they're not trying to help small businesses, but their main objective is to really minimize their own risk. And I don't think that ultimately serves the small business well. So what they wind up doing is in order to minimize their own risk, that winds up shortchanging a small business. So for an example, we talked about in our previous meeting and in our previous interview that many of them wind up they don't get to access the borrowing, the availability that they ultimately need. Mm-hmm. And so to minimize their risk, they often quickly disqualify what would be otherwise viable, good business opportunities, but for things that might be beyond that person, that owner of that business's control. So for instance, someone who hasn't been in business for at least 3 years, you simply can't control that. But that's the banking institution's way of saying, well, there's not a lot of established history here. And so in order for us to get comfortable and look back historically, we're going to see you have to be around for at least 3 years so we can look back and know that you have some track record. The other way that they do that is by saying, well, you're still a small business. I get that's wonderful that you've secured and won some really big new contracts. But when I look back at your history, okay, you have been in business for 3 years or 5 years, but when I look back, you only did, a few $100,000 or a couple $1 million in revenue. It's great that you have, 2 contracts in your hands for $20 million, but what your numbers show me historically, you can't support that. So I'm still only going to give you $50,000 or $100,000 in terms of credit. So I think they're ultimately out to minimize their own risk and serve their needs, and not ultimately the needs of the small business.
That's interesting that you bring that up. I can definitely see how that happens, right? Because I've heard so many stories of people who, and I'll tell you a funny one. This is funny. I remember a friend of mine, he went to the bank to get a line of credit, and they said that he was too liquid. He had too much cash. Have you ever heard that one before?
Yeah.
I was like, wait, this guy's got a 700 credit score.
Right.
He's got like $500,000 cash in the bank. And they were like, hey, they disapproved him because they said he's too liquid.
Yeah, it's sort of an oxymoron when you think about it. But again, banks want to serve their own interests and sometimes not those of their ultimate customers. And you can be too liquid. You can do things with that cash. You can abscond it and it can be gone in an hour. And in the bank's mind, they don't like that. They like to know, they want to go to sleep at night knowing that their collateral is safe, that they have access to tangible collateral that they can get their hands on if things go sideways. And so, yeah, it's nice to know that you have some cash laying around. But if you've got too much and that's all that's available to them, that could be gone in an hour or overnight. And, it doesn't make sense to us as logical people, but there is such a thing in their minds as too liquid.
Okay. Interesting. I brought that up because I remember all these different horror stories that we've had with banks and financial institutions. Speaking of that, can you talk about other ways where financial institutions have in the past historically exploited small businesses, or some of the tactics that you use
I think, and for those of you who didn't watch our previous episode,
Don't know where to start? Join our free course. Tired of working alone? Join 4,000 plus members. Have questions or want to talk to someone who's done it before? Join our free webinar. And all of this plus more is included inside of federalhelpcenter.com. Join today for free to get started.
I think, and for those of you who didn't watch our previous episode, I'm a recovering banker, so I have 15 years experience in banking before I participated and came over to the alternative and specialty finance side. So I really understand the tricks that banks like to use. And I think the biggest opportunity that they use to exploit small businesses, they like fees. They will fee you to death, Eric. And any kind of fee that you can think of, they will tack it on. There is an application fee. So just for you to have the privilege of applying to their institution, just to fill out an application, they're going to charge you a fee. There's a fee when you sign. They're going to generate their contracts, and for you to look over and review and sign, they're going to charge you a fee for that. There's a fee every month for them to basically review your account, and they call that a monitoring fee or a collateral fee. In the event that you say, you know what, I just want to have availability. I don't need to borrow a lot, but I just want to have this in case I need it, and they call that an unused fee. So in the event that you get charged if you're borrowing money from them,
Right.
and we all know what that is, and that's typically how banks operate.
Right.
But there's what most people don't know is there's an unused fee. So in the event that you just have a line of credit, and let's just say it's for $100,000, and you haven't borrowed a cent, they will often charge you what's called an unused fee, meaning even if you don't borrow one penny from them, they're still going to charge you a percentage of the amount that you're not borrowing. So you're sort of damned if you do and damned if you don't.
Wow.
So really look over your agreement with them. Look over what they tell you and what your contract says about fees. And there's going to be a lot of fine print and a lot of pages to go through. I would certainly recommend, if you're going to go down that road, that you have someone who's an outside attorney or has a legal background to review that information, because there's often things that are intentionally in there to confuse you that many of us as just business owners or general people wouldn't normally understand. And if you're going to read that, it could be a pitfall that could wind up costing you a lot of money, and you don't want to be caught up in that. So beyond fees, which banks love their fees, there are certain mechanics that banks use where they put very tight restrictions on when you can and cannot leave that agreement. Meaning, I'm working with a borrower right now. They're working with the bank, and they're trying to actively leave. They're being restricted on how much they can borrow, when they can borrow. They're not getting all the availability that they need. And they've got some very big contracts. They're working in the AI space right now. They have a lot of AI programmers they're deploying. And the challenge is the way that their contract is written with their bank lender today, there is no clear definition on how they can exit that agreement, other than they have to be able to show to that lender that their projections in the coming year for 2025, they have to be able to show that under the current lending guidelines and offerings that they have, that lender is unable to meet the needs of the borrower, and they have to be able to show that somebody else, us in this case, has better terms and will allow them to get more availability elsewhere. But beyond that, the contract becomes a little ambiguous. All it does is that says you have to demonstrate that you have greater availability somewhere else. Doesn't say how long that they can take to get back to you. Doesn't say if you prove that, when you can leave. Doesn't say how you can leave. So that's why I think it's really important to have somebody outside beyond yourself that has specialty and the knowledge to look through this information, because it's lengthy, it's dense, and there's a lot of terms that just most people don't understand.
You know, I've never heard that before, where you said that they don't allow you to leave. That's really interesting. I would think that you know, like, hey, I give you your money back, I'm out of here. Like
you would think so, but again, back to protecting their own interests. A lot of it is designed in their minds. If it's to a specific date, it's a contract date that's in the future. In their minds, that's lost revenue that they would have missed out on if you're going to exit today.
Wow.
And so they want to capture that. So the other thing I think is important to look out for is that's, again, it's intentionally vague, but it's important. If you're hearing these types of things, a limit up to. So oftentimes the bank will say, we will make available up to. Well, that sounds great in theory. We will make available up to $50,000, up to $100,000, up to $1 million. But again, that's very intentional. Up to means in the event what that really translates to, Eric, is in the event that you do exactly what we want and exactly how we want you to do it, and you follow all the guidelines and jump through all these hurdles, then we'll allow you to get to the level that you really want to. But if you don't, you're going to be back down here. So it's sort of like this carrot that says, hey, if all the stars align and everything goes really well, then we'll let you go up to that amount. But if you don't, you're going to be back down here. So again, these are just things that I've seen over the years, and different tricks that people play to draw you in, because it's very shiny and new. And hey, look, you can get all this money up here. But what you don't realize is, as soon as you get there, you realize that it's going to be really difficult to achieve some of the milestones that they require you to get to that point.
That's interesting that you bring that up. What are some of the red flags that we should be looking out for when we are talking to different financial institutions or lenders? What are some of those red flags that might just stand out that we're like, if you see this, be careful?
Well, that's probably a perfect place to start in terms of red flags is the up to language.
Gotcha.
Because
Yep.
There are often things that you have to qualify in order to get through that. That's sort of like if you're watching a commercial and it says you can get these fantastic rates, but the fine print at the bottom you can't read on your screen says you have to do all these really good things and you have to be perfect and pledge your firstborn child to us and all this stuff. Here at Encore, the nice thing is there is no up to. We provide unlimited capital to all of our clients and to all of our partners to be able to grow their business to the extent that they want to grow to. Many of our clients that are working in the federal space, we feel really good about when they send their invoices to the federal government, that the government's going to pay those invoices. I'm not worried about the U.S. government's ability to pay. It's just a matter of when. And it's usually pretty timely. So we feel comfortable and confident that there is no up to at Encore Funding. So it's important that could be a red flag sometimes when they're saying you can borrow up to this much. So that's an important thing. I think we talked about a little bit before, fees, when they're saying no additional fees, or there may be some fees, but then, go see this other section over here for the list of never ending fees. Again, here at Encore, we believe fully in transparency. We have you as a client, you will have access to a system. It's live 24 hours a day. You will see exactly what we see, and it's the fee structure that we discuss in our proposal and that's in our agreement together are exactly the fees that you're going to pay to us. There are none of those other fees that we described. There is no application fee. There is no monitoring fee. There's no documentation fee. There's no collateral fee. The list can go on and on. And in terms of collateral, that's another thing I think it could potentially be a red flag. Banks sometimes will tell you that what you're offering them is not enough. And so they may ask you to pledge additional collateral. And so sometimes that may be your personal residence, your primary residence, or that may be additional cash that you have set aside, or maybe that's an investment account you have, or maybe that's a retirement account that you have. Encore is not in the business of being a real estate lender or a real estate holder. So we're not asking clients to pledge their houses to us. We're not asking them to, if you have a recreational vehicle or a boat that you like to go fishing on the weekends, we're not asking you to pledge that stuff to us. We believe that in the information that you provide us and that you have the collateral in your invoices that we're going to be lending against, that's enough for us to feel good and comfortable to do a deal together. We don't want to be in the business of liquidating houses or other types of collateral. So I think when you're talking about the different types of fees, those are some things that I think are red flags and could be potentially dangerous when you hear or see those things, because when you start to peel back a little bit, there's a lot more underneath there. And because oftentimes the bank will say, well, your rate is this, and it's typically low, and it's sort of like a little bit of a teaser, and they just want you to get all the attention and look at this new object. It's really shiny and pretty, and don't look over here though, because pay no attention to the man behind the mirror. There's all these other fees. And the reality is when you add up this nice really teaser rate, but when you add in all the fees that go along with that, or if there's an annual fee or there's monthly fees that add up to an annualized number, you're often far exceed any competitive rates that a lender like Encore is able to provide. So it's not just about, well, what's the fee for borrowing? It's all these other fees that add up, and that often will put you over the top. And so it's important you consider all of that when really comparing deals side by side and different offers that you have.
I like that. The analogy that comes to my brain is if you were to buy, like, for example, me. So I take American Airlines. I come here. And so in American Airlines, I get my free, bag check. And I get upgraded or suggested upgrade. But then if you were to take like a Spirit, then you got to pay for your bags. You got to pay for early check-in. You got to pay, And so when you compare it, right, it's like when you look at it, it's like, hey, Spirit is like $100, right? America's $300. Like, well, it's cheaper. But then when you add in all of the luggage, the bags,
right,
the check-in, the desk, and I think Frontier, which I know Frontier, I have to pick on them. From my understanding, if you just fit a certain size, you got to pay for that bag, so you got to pay. And then you have to pay to print your ticket, or if you don't have a digital ticket. So yeah, that makes sense to me. And I never consider banking that way because we all just look at the bottom line interest rate. So we always say, okay, this is the rate. This is what we're paying. But you're right, because every time I go to my banks, they've figured out some way to charge me fees.
They have done a good job of lulling us into a false sense of security.
Right.
And maybe they just have really great marketing teams for years and years and years that have said, we're going to provide you really great rates, but there's all these other, fees that are in fine print that you really have to take into consideration, because some of them may be one-time in nature, but there are often, as we look at contracts all the time, where there are at least monthly, if not annual. And when you add those up, just like the example in the airlines, it's going to wind up being the same, if not more, because you're getting nickel and dimed along the way, and it becomes damaging at some point.
Listen, if there's no way I'm going to pay the same amount on Frontier that I'm paying American Airlines. I mean, because I'm going to have a better seat. I'm going to have, it's going to be more spacious. So even though this cost is the same, identical, like you mentioned, the comfort that I receive is going to be way far greater.
And the experience is generally going to be different as well. Right. Not just the airline. I think the same example is similar to in the borrowing experience, where you can go get this really ridiculously low rate that you think you're getting, but by the time you add up all your fees, and so maybe somebody threw that out there because their cost of capital is really low, so they can entice you with this really fake low rate.
Right. But
the reality is, maybe you just partner with somebody who has no idea about your business and doesn't understand anything that you do. So similar to your airline experience, you're still going to get from point A to point B, but it may not be fun. You're probably going to get delayed. Your bag might get lost.
Right.
It's going to be a similar experience if you're going to partner with someone who says, I'm going to give you often get what you pay for.
Yeah.
And I would tell you that the lending business is no different.
So given all these things that you've presented to us, what are some ways, protective strategies that we can, protect ourselves against these things? Like, I mean, it's got, this seems very overwhelming. I mean, first of all, I've seen those contracts. You can't read all those contracts.
No.
Because they said, reference this document, and that document reference this other document.
Yeah.
And you're like, wait.
Intentionally confusing.
Yeah, right.
I just saw a contract. It was 162 pages. That's the longest I've ever seen. I've been doing this for a very long time. That's the longest I've ever seen. And no reasonable person can go through that and follow. And you're right. It is often, they're referencing other sections in the agreement. It's usually not that's in a uniform manner that says, okay, just follow along. This paragraph goes to this paragraph. It's often referencing definitions that make you jump from page to page to page. That's a crazy example, but many of them are extensively long. So it's difficult to understand. And there are definitions in there that if you're not financially savvy or doing this every single day, you're not going to quite understand. So do your homework is what probably the most important thing that I could recommend to anyone. Do your homework. That doesn't mean you have to be an expert in this business. It doesn't mean you have to fully understand and do a deep dive on banking or specialty finance. But do your homework. Go out there. Talk to people in the industry. Work with people who are advisors into that. Talk to trusted partners like your CPA, like your attorney, other people like you who have been in and around this space that maybe you don't do this day to day, but you have found reputable people that you think do a nice job and can be trusted, that work with clients and have had good experience. And I don't think it's a bad thing when you go to work with a new finance partner, asking them to speak with somebody who is a current client that can give you some sort of reference. Boom. Now, you could say that's a sort of a self-serving type of request, because if someone asks me, I'm rarely going to give you someone that's unhappy.
Right.
But but it also gives you a little bit of peek into what you're getting yourself into, and they can give you insight.
I like that.
But as we've said in previous episodes, go online, do some homework. You can't hide from anything these days. Everything is digital, and people are going to be loud and proud to say what they're feeling. So if they had a bad experience, they're going to go and post about it. And it's going to be on a Google review or on any variety of these other, like a Better Business Bureau. It's going to be out there, and it's going to be available for the world to see. So go and do some homework. And if you're seeing a trend for some companies there's people are consistently saying things that they're unhappy or they felt were deceptive practices, it's probably not just, these probably aren't isolated incidents. So do your homework, work and consult with trusted advisors. And I also think ask questions. Don't be afraid, even though you may not be an expert in finance, ask questions about your new financial partner. Ask them about how long they've been in business. Ask them about the types of businesses and customers that they work with. Ask them about what their portfolio looks like in terms of the mix and makeup of businesses, how big, how small, what industries they serve. Where do they tend to play themselves? Meaning, what conferences do you go to? What industries and associations are you active in? Because I think that will tell you a lot about that particular finance business. It will tell you, it's not a secret. We have posted on our website, I think there are probably a dozen or so associations that we belong to all across the country that we belong to. We are actively involved in. I had mentioned in an earlier episode that we did, we're going to be at, I think, 22 or 24 different conferences this year. So we are actively out talking to people. We're out in our community. We're participating in different events. And I'm happy to share that with people when customers coming in and are asking, what do you guys do? What do you specialize in? Who do you talk to? I'm happy to share that with people. But I'm guessing that not all the other financial institutions are doing those same things. And so you ask them those questions, they might squirm up in their chair pretty quickly. But that should also be telling of their response and how they react to those kinds of questions. Because if someone's going to ask that of me, that's not a secret. Those are all things that we publish very openly. And if someone is unwilling to answer a lot of those questions, you might want to think twice about what their intentions are and if that's the best partner for you.
No, that's a great point you bring, because as much money as I've given to some of these banks, I've never been in their offices. I ain't never met their people. I've never met nobody except the person behind the desk. And here we are, having a chance to walk through your offices, come out and sit down and talk to you guys. I met you at a conference, an event, like you mentioned.
Yeah.
And then here we are in your office, having a conversation about finance and opportunities for small businesses out here. And I've met your CEO multiple times. You guys came to my conference and spoke. So I would second that you're out there and you're visible and you're present.
People view their finance partner often as transactional because money has turned into such a commodity these days, because you don't need to be, you're not forced anymore to walk physically into a bank to get money anymore. You can get it in a variety of places. And with the ease and access with our computers and our phones, you don't even have to get off your couch or out of your chair to access dollars anymore. So, but the thing that we have always prided ourselves on here at Encore is that we want to be open and we want to be transparent about what we do. And so this is very much a relationship driven business for us. This is not transactional. And so we love having people come visit our office. We want you to walk through. We want you to see that this is a real business, that there are people out here that are working hard on your behalf to make sure that you get the dollars that you need, that you get the advice that you need, that to make sure that money's coming in when you need it, and to help grow your business. And it's important. So we love having clients come visit our office space to see, look at all the people here who are in your corner that are rooting for you to make sure that you grow your business and get the success that you want to see out of it. And if someone is going to deny you that opportunity, you may want to think twice about that, because, perhaps they're sort of trying to perpetuate something that may not be fully accurate on who they are or what they can actually provide you. And that's why, this is an open door. And that's sort of, that analogy has become overutilized, I think, but it really is here. The people that we have here, our team is the special sauce, because those are the people that our clients are working with on a daily basis, those are the people that are supporting your business every day and helping you grow. And so we want you to meet them. You talk to them every day, but we want you to meet them face to face. We love when you come here. We want to sit down and let's talk about your business plans. Let's have lunch together. Let's do some these fun things. Let's explore the city and really get to know what's happening in your life, what's happening in my life, because money has become such a commodity that, there's always some place to get it cheaper, but you're going to get what you pay for. And we really want to empower small businesses to get what they want and achieve their version of success. And I think that we're able to deliver that through the awesome team that we have here at Encore.
So going back to some of the other groups that we've been talking to, what are some ways in which myself, we can negotiate, I guess, strategies to negotiate better deals? It's funny because, again, we talked about red flags. We talked about things that people have been traditionally doing and making us put collateral. But so how can we, I feel like my back's against the wall. I don't know what I can do, right? Like, what can I do? Listen, even if you tell me a prompt to put in ChatGPT, man, just something. give me a place to start.
That may not be the worst place to start.
Give me something to start with. I'm a regular guy. I don't
probably
know.
ask ChatGPT what are some good negotiating strategies when working with a financing partner.
There you go.
But AI aside, I think there's a couple things to take into consideration when negotiating with a finance partner. One, you should absolutely do your homework and understand who you're working with and knowing what their capabilities are, because sometimes you might be asking for things that are just unreasonable or unattainable. So we've previously talked about, if you're going to be working with a community bank, sometimes there is such a thing as too big at a community bank.
Yeah.
Thankfully, that's not a problem that we have here at Encore. But if you're going to go to a smaller lending institution, there may be such a thing as too big. You may be asking to be able to borrow dollars that they physically cannot produce for you. So doing your homework and understanding who you're working with to make sure that what your asks are, that they're within reason. Also, having a general sense of what the market is bearing. So meaning, I'm just making this number up, but if generally, rates are, in the high single digits to low double digits, it wouldn't make sense for you to go in, if that's what the market is bearing, and go in and asking, I want 2%. It's just not realistic. So yes, everybody wants the lowest price, but having a general sense of where the market is, you don't need to be an expert in what's happening with the Fed and sort of having a broader overview of the U.S. economy, but just a general sense of where rates sort of may or may not be. And then I think the other thing is it's important maybe to understand is ask your lender potentially where those funds are coming from, because something that they're taking into consideration when they're providing dollars to you is there is a cost to them. So whether they're a private company like us or whether they're a chartered banking institution, those dollars that they're lending have a cost associated with that. At a banking institution, those dollars, the cost to them, they're paying those depositors. So when you keep money on deposit at a banking institution, they're paying you an interest rate. Mm-hmm. That rate that they're paying is lower that they're lending those dollars out at, and that's how the bank essentially makes money. There are a variety of other ways and lots of other products, but it's at the most simple level, they're going to lend money to businesses at a higher rate than the amount that they're paying people to keep those dollars on deposit.
Okay.
When you leave the traditional financing banking institution, you leave that world, you get into the private world, and those dollars usually have higher costs associated with them, and often there are a variety of pools of where those dollars are coming from, and those pools, depending on where they're coming from, other institutions, individual people, wherever they may be coming from, they have costs associated with them as well. So asking your potential finance partner about where they get their capital can be indicative of something that they may or may not even be able to help you with in terms of what is a reasonable request when it comes to cost. Meaning there is cost for them to provide those dollars.
Absolutely.
So they're not going to be able to give it to you for less than it costs them.
No, of course.
So having a general sense and education about that makes sense for you to come prepared. So I think the other thing is when you're coming and you're talking to a new potential partner, be realistic and understand that there has to be some sort of trade-off. If there are 5 things that you want, as an ask or want to negotiate on, you shouldn't expect that you're going to get all 5 of those things.
Okay.
I don't think that's realistic. You can probably expect to get probably 2 or 3 of those things, but I think it's unrealistic to say, I want all 5 of these things and pound the table, and if I don't get all these 5 things, I'm going to walk. Yeah. And maybe that's fine for some people, and then they can continue to go through the process and shop that around. But I think have realistic expectations. When you come and you want to negotiate and have someone that wants to come to the table and find some kind of common ground, be realistic in what you're asking for, and that, you could probably get a couple things, but if you think that you can just clear the table, that's usually unrealistic. And so be prepared to have some realistic expectations about in a trade-off that if you're asking for a couple things, that they're probably going to want a couple things in return.
But what things can I ask for?
Certainly the easiest thing and most people are going to focus on is the rate and the cost.
Okay.
Because that's the most obvious thing when we're talking about financing transactions. But not for us, because it's not really applicable. We don't have any additional fees, but in a traditional banking institution, all these other fees, that's probably always negotiable in terms of, when they're going to charge you to fill out an application or to complete their documents, those kinds of things. Sometimes if there's a term limit that they're going to want you to sign for an extended period of time, sometimes the length of that is negotiable. So it really is. It depends on, and if there's a dollar amount that you're seeking, I think those are sometimes things that are negotiable as well.
Okay. You mentioned that depending upon the time, right, and the rates are this and the rates are that. Obviously, at the time we're interviewing this right now, we've got a new election, we've got a new administration coming in, right, and lots of regulations being thrown around. Do you see any of that having an impact on us right now with rates, or is it positive? Is it negative? I mean, or maybe even not the administration, just any type of regulations that maybe I'm not thinking about, or the people out here, what maybe you want to start with what regulations impact things, and then we could get to the second part of the question, which would be if there are any things changing now with the current administration.
Sometimes it's the right question to be asking, given that there's a new administration that recently came in. We're only a couple months in, so I think that it may be too soon to tell. But generally, when you talk about compliance and regulation, that from a lending side, I think about that back to my banking days. Generally, more compliance and regulation, in my mind, as a banking institution, usually equals more cost, because there are things that as a bank you have to now find yourself, there are different standards or ratios or things that you have to hold yourself accountable to, because there are guidelines or laws in some cases that say you have to be in a certain position. You have to keep a certain number of certain ratios or dollars on hand or levels of capital that are required. And this usually winds up meaning that you have to have additional people. There's additional time spent, money spent going into this. So that, in my mind, that always winds up adding up to cost.
Right.
And there are 2 choices you have when you have more cost. You can bear the cost as the business, as the lending institution. That will eat into your own margins, or you can pass that cost along. And what most find is that they will pass that cost along. So highly regulated environment translates into cost that usually winds up into higher cost and or fees to the borrower. Not always, but that's typically what it winds up being. And when I think back to my banking days, and shortly after the 07, 08, 09 challenge, when there was a big downturn, there was a lot of regulation that came out of that, where I found myself spending time that was not on revenue producing tasks. It was regulatory and compliance related tasks to make sure that we were within certain ratios or had certain levels that I was always checking and always measuring. And the bank or any business doesn't want to be spending time on things that costing them money versus spending time on things where they can be earning money. So I think it's too soon for us to tell, but it's also interesting because out of that period of time, that economic downturn, came consumer finance Protection Bureau, which is also, it's timely because that's one of the many organizations that's being looked at to be potentially eliminated at the moment. So it'll be interesting. Now that group has a lot of oversight into lending and regulatory institutions to make sure that consumers aren't being taken advantage of when they're going to borrow money, whether that's for personal use or for business use. So there could be a lot of this trickle-down effect as regulatory oversight changes for better or for worse. I think it's too soon to tell at this moment, but that may change over the next 4 years.
Do you have any real world examples of someone who was able to navigate this system and come out with fair terms?
I do. So there was a client that we had a few years back that I think about, and clients sometimes like to transition when they transition out from our type of financing, which works really well for growth-oriented businesses. This client had sort of had grown her business very successfully, and we were really proud to be a part of that, and part of it from very early on, saw the huge trajectory, and it started to plateau. And there are plenty of businesses, as time goes on, they're looking to exit as owners and founders, or those businesses, as they continue to age in their own personal lives, they're transitioning. They have families, they're into other ventures or have other interests, and so the business is not quite on that same upward growth trajectory. So, and it becomes more of a lifestyle business, just to sort of support your day-to-day living. So this client transitioned over to a banking relationship, and so she had, I don't even remember how many years she had been in business before, but it was at least 10 or 15 years, I think, probably. So a long track record of success, lots of growth to look back on and be proud of. So again, if we think about sort of putting our banking hats back on, lots of consistency to look at over the years, lots of predictability, not a lot of this volatility of up and down and up and down. So they like to see that. That gets them very comfortable with those types of situations. And when you're out of this sort of high growth mode and you're more in a plateau and consistency, banks like that. So she had grown to a level that was favorable to them. They knew that they could make a nice size lending facility, that there was a decent amount for them to make. And so I think she was also of a size that there was a lot of interest, not just at one lending institution, but multiple. So she was able to secure those terms, and we were certainly able to help her, because while we were sad to see her leave, this is someone we had a very nice relationship for a very long time, happy to see her have success, knew that she would be exiting probably a short time thereafter, and wanted to help her transition to more of a traditional lending facility. And so are able to look at what some of those terms look like and say, you know what, this is probably something you may want to ask about, or this is something you may want to push back on a little bit. And so we're happy to do those sort of things. We don't want to lose people. I'm certainly incentivized to put as many dollars out in the street as possible. But when people have decided that they want to move on for whatever reason, I want to make sure that they're going to go do what's best for them, because we develop some genuine relationships with our clients, and I would even call some of them friends. And so no different than I would want a personal friend or a family member to go do something else. I want to make sure that wherever they do go, they're going to get the best deal possible and have the most success and whatever is right for their business at that time. And that's exactly what we did to make sure that she wasn't stepping into something where someone was going to take advantage of her because she had a nice sized business and people thought, wow, we can make a lot of money off this. Let's just fee her to death and do all these other things. So we had a really nice success story with that, and we were sad to see her go, but she did shortly exit there afterwards and had some nice success that went along with that.
And for those who listening, exit means she sold the company.
Yes, sorry.
That's okay. I just want to just clarify. Yes. When you say exit,
yes,
it wasn't
an exit like a stage left and she right. About she sold the company and had a nice payday. That was really worth it. You realize a lot of the hard work, the blood, sweat, and the tears that go into building a business. Right. And so having an exit like that, and where you realize a sale and have a capital event, is really a nice reward. But there's a variety of ways that you could exit. Exit doesn't necessarily mean a sale. You could also you could bring in a new generation. We have lots of clients here who have second and third generations that are now running their business, which is great to see. We have people, that have been in business for over 50 years, which is really cool to see. And they now have their grandkids that are a part of it and running it. So there's a variety of ways that you could realize some of that. Or sometimes you exit and you sell to a competitor, you sell to a private equity company, you sell to an unrelated third party. So there's a variety of things, and we can do a whole separate episode on that, what that looks like.
Oh, people want to hear that. So it's safe to say, and that's what we have a saying, is that banks only lend to people that don't need money.
Maybe because
that's all right. No one's listening.
They want to take they want to take the safest bets,
right?
And the safest bet is going to be someone who almost doesn't need it,
right?
And so that's I go back to sort of, and it's not that I'm knocking the banking business, but it's the most conservative type of financing that there is. So because they many of them who are public, they have to be accountable to the street, and because they have shareholders and they have to report to the SEC, and they have all these oversight and regulatory requirements. So they can't just sort of do what they want and then hide the results. It's all very public. It's all out there. It's all gets published and anyone can see. So they're not big risk takers, and they want to make sure that they're very conservative about what they do. So what's the safest way to put money out there is to people who almost don't need it. So
right.
I would argue that's probably a fair statement.
Right. What do you think about SBA loans?
SBA loans are a good thing, but there's a time and a place for them. It's something that I think is worth considering, but you should think about where you are in your journey and what it may do subsequently to potentially stifle you on your future plans. So SBA usually offers really favorable terms to newly formed businesses. So the rates are typically low. The repayment terms are fairly extended, which means translates into lower payments. So it doesn't cost you a lot every month to be able to borrow a decent amount of money. The problem with that is since the SBA doesn't have an outlet to deliver those funds, they partner with almost every financial institution out there through their retail operations to get those dollars lent out on the street. So we have many of those here in Cleveland that originate the SBA loans. And the nice part is the SBA guarantees a portion of that loan. So in the event that you're unable to pay it, or some of it needs to be forgiven, or there's a downturn in your business, the SBA, because that's how you're able to get those favorable terms with the bank. The SBA is saying, we're going to guarantee most of this loan. So the bank feels really good about that. The challenge is that in the event that you borrow a decent amount of money, you may not be able to pay that back. Even if they give you a long repayment period, even if they give you 10 years, and the problem becomes your needs may become greater before that repayment period is over. Mm-hmm. So I'll give you an example, Eric. So what happens is, we were working with a client not too long ago that had a great SBA opportunity. They lent them, I think it was somewhere in the neighborhood of $800,000, and they were I think the business was only 2 or 3 years old. I was really surprised at the dollar amount. I thought it would have been much lower in the $100,000 or $200,000, but the amount is almost irrelevant because they had made them a loan, and it was a 10-year repayment, which is nice because it stretches out those payments. It gives you the ability to make a reasonable amount payment every month. Well, the problem was, they had used that to acquire some pieces of equipment that were expensive. So the money had been spent. Problem is, now they were out searching for contracts. Mm-hmm. and they had secured some. Well, the problem was, they had this very large loan on their balance sheet. The money had been spent already, but now they needed more money to service some of the newly awarded contracts that they have. Yeah. Well, Encore would be the first person to step in there to be able to support your working capital needs to service those contracts. But the problem was, these were brand new contracts. They were just starting to generate invoices and accounts receivable with them. And there was a very large balance that was sitting on the balance sheet owed to the SBA that this particular client didn't have the ability to pay back at that moment. Right. And we couldn't generate additional dollars because we're just helping you fund your invoices. We're taking that and turning that into cash. They didn't have $800,000 worth of invoices at that point that we could go back to the SBA and say, let us pay that off for you. so you can move out of a secured position. So in that particular instance, we weren't able to help that client.
Okay.
So like I said, I think there's a time and a place for those loans, but sometimes it can impede your future plans, because if things start to pick up and you have this very immediate growth trajectory, you may not be able to get that loan out of the way to be able to work with a lender like us.
That's interesting. As I think about that, a lot of us, especially during COVID time, had those EIDL loans,
Yeah.
PPP, right? And, those financial products. And I'm going to imagine that we still have some of that stuff sitting out there.
There's a lot of those EIDL loans. The nice part about that is because those were issued under, for the most part, once in a lifetime circumstances.
Okay.
And the SBA this is one thing that I think that they did really well. They issued a lot of those EIDL loans during COVID, knowing that people were going through financial difficulty.
Right.
The world and the supply chain came to a grinding halt. People just weren't doing business as usual. So when they were making those loans, they said, we're going to make these loans. They're all under favorable terms. What they did really well post-COVID is they're traditionally saying, not always, but in our experience, most of the time, if another lender like Encore wants to come work with a business who has an EIDL loan, which, by the way, for the audience, is different than a traditional SBA loan.
Good.
They're made under different circumstances, and if you're not sure which one you have, you can ask your loan officer or call the bank or look at your loan documents, or send them to me. I'd be happy to look at them for you. They're just made on different terms. But what the SBA did do was they said, if you have an EIDL loan and you're going to go work with another lender, we issued those EIDL loans in order to help prop people up during a period where there wasn't a lot of economic activity. So if you want to now go work with another lender like Encore or whoever else, we will subordinate those loans to Encore, meaning we will let Encore have a first position security interest in those assets. And for many of our clients, those are your accounts receivable, because most of them are service-based businesses. And we will take a subordinate position, meaning we will go to second position behind Encore. So really for us, that just means that in the event that we need to gain access to your collateral, liquidate that, which is so far and few between it rarely happens. But in the event that it does, we just get access to that collateral first before the SBA does. Now, if you have a traditional SBA loan, the SBA will not subordinate. They will say, sorry, that's our collateral. We're in first position. We will not go behind anyone else. But what I think that they did a really good job of, if you have an EIDL loan, they will subordinate that, because those loans were made during a very difficult time economically, and they recognize that people now need additional financing. So they're saying, yes, we'll go behind somebody else if they want to take a senior position.
All right, and I want to close out with this. Tell us the top 5 things people should know about Encore Funding.
Top 5 things that people should know about Encore Funding. Number 1, we focus on you. So what does that mean? We do, our CEO, Joel, who, for those of you who haven't seen, Eric did a great interview with Joel a few episodes back, so check that out. But Joel has always said, we're going to do one thing really well, and that's providing working capital to entrepreneurs. And that's exactly what we do here. We focus on your type of business, and we understand what you do. So in a previous episode, we talked about going to a traditional banking institution or a community bank and trying to explain to that person how your business works and what it's like to work with the federal government, or to how to explain how a government contract works, or these awards that are, in single years or in multiple renewal years and things like that. And all the requirements that go along with that, and the nuances of insurance and all these crazy things that most people just don't understand. So we do one thing really well, and that is we are in the business of you. So that's something that I think is really unique, and why clients have enjoyed working with us over the years. Number 2, I think if you come to Encore, this is not a transactional relationship. This is a group of people who care about you and your business, and this is more than just money. There used to be, I used to have a sign outside my office. We had some posters and just some marketing material, and this has stuck with me for 13 years. It said more than just money, and it was had clouds, and it was a silly poster, but it always stuck with me because I chuckled when I would just to walk by it, but it's true, and I think that's sort of how we separate ourselves from everybody else in this space. It really is more than just money, because you can get money everywhere. You can pull out your phone, and probably within 10 minutes you could probably get access. Now it's a matter of how much and what it's going to cost and any strings that may be attached to it. But so I think the second thing is that it's more than just money. And this is really a relationship business for us, and that we really do care. Number 3, we are out in the community. So this isn't a scenario where we're just sitting behind our desk and we're hiding from people or just trying to make a buck. We really want our clients to succeed. So we're out visiting your offices. We're out at conferences. We belong to a variety of associations. We truly have the best of intentions to break down those old stereotypes and make sure that people see us as partners and are here to help you achieve the success and the vision of your dreams, whatever that may be. So we're out doing what we are trying to do and help you grow your business. Number 4, working with Encore provides you access to unlimited capital. And that is something that I don't think a lot of financing partners can say. I know that you're not going to get that at a bank. They're going to give you it on your term sheet. It's going to say, and in your contract, it's going to say a very specific number, and that's the number that you can borrow up to. And so working with Encore provides you unlimited access to capital. And that is a very unique thing to be able to say, and be able to say it proudly. So when you're looking at your offers out there, and if you have existing finance partner, understand what your access to that capital is and where that ceiling is, and know that your friends at Encore are waiting for you to pick up the phone or come over to our booth at the conference and to learn more about what we offer, because there's a lot here that you may not be getting with your current partner. And the last thing I'll say, Encore is about real people. We have the pleasure of taping this episode today in our office. We have probably 60 people here in our office in Cleveland. We've got maybe another dozen or so people in our office in Buffalo, and then maybe another 10 or so people scattered on our sales and marketing team throughout the rest of the country. And so these are real people who are here. They have names. We have pictures on our website. These are people who answer the phone when you call them. They respond to emails. And a lot of the frustration that we hear from clients as they come on board is, you know what, when I had a question, I couldn't get in touch with somebody. The phone would just ring, or it would just go to someone's voicemail, or I would send an email and it would just go into a black hole. And the thing that they love is that the people at Encore are real, and that we're here to answer your phone calls. And when they have an emergency, we're able to help them out, and they're in a pinch. And sometimes that's at weird times. That's off hours. That's, you try, good luck. You call the bank at 4:30. Good luck trying to get someone on the phone, especially if you have an emergency and need some help.
Not happening.
We've helped clients out of some extraordinary situations, and sometimes that means, at very odd hours, or sometimes on the weekends. And I'm not encouraging people to call us, at the crazy times. But when you form these kinds of relationships, we are vested in your success, and we want to make sure that you get what you need. So we're willing to go out of our way to make sure that if there is a situation, or you're in an emergency and you found yourself in some sort of trouble, we want to figure out a way to get you out of that. And that goes a long way. And having the ability to form those kinds of relationships with clients, that transcends everything. And that goes beyond the ability to access dollars. That goes beyond cost or fees. And I mean, understanding your business is important, but to be able to help people and knowing that we're here and have their back, I think that's really ultimately what we are about at the end of the day.
I think that's super important, because as federal contractors, I can't tell you how many times that we get a last minute call with the government saying, hey, we submitted something months ago, and they're like, hey, is this price still good? We want to get started right away. And you're like, wait, I've been waiting for months. And so the opportunity, we can't afford to turn it down. So it helps having someone that will be able to be that responsive, because I can't tell you the number of times where we've received last minute calls and saying, can you jump on this immediately? So, and I know, and my experiences of talking with you and helping some of the people that already we've brought to the table, that you've been able to do that over the weekend. So I can attest to that. And having met a lot of the people in the staff. So thanks, Craig. I appreciate your time today, man.
Thanks, Eric. Thanks for having me.
Talking with you, and looking forward to working with you guys in the future.
Likewise.